Hello, everyone, and welcome to another season of ADP, Accounting Design Project. This is our eighth season now, I think, Young, isn't it? And we're quite happy about how it's been going. It's wonderful to get a group of scholars together from around the world who are interested in what we feel is the core issue of accounting researchers to think about what's good accounting and what's bad accounting and how you make inferences from the accounting and how you use the accounting. That's the spirit. Thank you again, everyone, for joining us. We had quite a number of submissions. We had to be selective, and sorry for those we couldn't choose. But I just wish us all a very productive and happy semester. It's wonderful that people around the world can join. I'm sorry for those in Asia and Australasia have a little bit of a sleep problem, but this is what we can do. Typically, these seminars will be on Tuesday at 12:30. Occasionally, they will be at 12:30 Eastern time. Occasionally, like today, they're going to be on a different day because of schedule conflicts. So please note the dates and times of Pacific seminars. Anyway, welcome again, and it's over to you, Mamie, to introduce John, our speaker of the day. Thanks very much.
Thank you. We are pleased to have John from the University of Georgia today, and the title of his presentation today is The Amount and Quality of the R&D Capitalization under International Financial Reporting Standards. And we are excited to have started the new accounting design project from today. And before we start, I want to share some housekeeping rules. And as usual, when you have a question, please use the raise hand function to let me know. So I would call following the order. And of course, you could share your comments on the chat box as well. And so without further ado, let's start. John, floor is yours.
All right, well, thank you everyone for this opportunity. This paper is, we finished the first draft in November, and this is my first time presenting it. But it's one of the papers I'm most excited about in my pipeline because of what I think it has to say. This paper was actually sort of an initial thought of Huxia Chen, who's the first co-author listed here. He's a PhD student at Renmin University of China, and they knew about the regulation changes that were happening and were collecting data to think about it. And then her advisor, Keng Tao. And then Jenny was a student of mine. I was on her committee. She's at Monash, but was a Renmin undergrad. So that's how the team came together. But it really started with sort of their institutional knowledge of the Chinese setting. And then when I talked to them, realized sort of what it could do from a potentially U.S. perspective. So the guidance I was given was that at some point I needed to discuss how my study helps us think about the accounting design issue. Is there any potential policy recommendation from your study, even in conditional form? So I thought I would spend a second telling you sort of about the topic and how I'm aware of what regulators are thinking about. So I was invited to the 2023 Financial Reporting Issues Conference, which is at the FASB. Every year they do it. And in 2023, the topic, at least for part of the time, was on R&D accounting. And, there was it was a conceptual exercise. Does this qualify as an asset? Does it meet the definition of an asset? If so, how should we measure it initially and then subsequently? And in the group I was in, I don't want to speak for everyone, but most everyone agreed that R&D activities tend to most of the time meet the definition of an asset. It's a present right of an economic benefit. But then I think where people struggled was, okay, then how do you measure it? Like if it is an asset and you should put it on the books as an asset, how would you measure it? And when does it go from sort of exploratory to, okay, I've got something that has an economic, purpose. So when do you move from maybe the research part of things to the development part of things? And one of the practitioners in my group was saying, look, you can let managers value this stuff, but it's really, I mean, it's almost like valuing a risky bet. You don't know. It would be very difficult to do this. Would it be helpful for you to see managers' risky bet number, or should you give the underlying information to investors and let them decide? By the way, if I'm auditing that, how am I supposed to audit that? And I think it became trickier. So then, if you recognize it as an asset and subsequently impaired, is that better, than not? Is that better information than fully expensing? And the other obvious thing is, if you let managers capitalize it, will they, not expense things that should be expensed for income smoothing purposes, income management, earnings management. Now, also in the background of that was the discussion at the conference, but also in the background here is like, academic research is showing that R&D is positively associated with firm value, but we're expensing it, and when we think about, I think Anoop Srivastava at the RAS conference a year or two ago showed a graph and like, this is an expense component, but it's positively associated with value. So does that make sense? And accounting in general, I think, is not a secret, is criticized for not keeping up with the new economy, right? Like that basically saying we're leaving substantial assets off the balance sheet. But my sense from this conference was that there just was not a lot of appetite in the US for capitalization of R&D. I think for a number of reasons, but I do think there was a desire for improved disclosure so that investors can better assess the R&D activities for themselves. And so this is what I think ultimately led to this project realizing like, hey, if there is, because of the Chinese setting that I'm going to talk about, there is actually some disclosure that is required that might be able to that we can maybe learn from, in addition to being in a setting where investors are able to capitalize R&D. So the two
Hey,
prime,
John,
yes,
I'm sorry. There were some questions coming. So,
okay.
So the first question, I don't know if it's a question. So the first question we got is from Jill on the chat box. So Jill, do you want to speak up?
That's fine. That's fine. I was just making a comment. This is, there's the asset definition of an asset is a probable future and economic benefit. And it maybe if you take some of the publicly traded companies, you'll actually see a lot of success in R&D. But if you take the economy as a overall, if you look at startups, R&D is, I'm not sure, in most cases, fit that definition of an asset, because it's not a probable future economic benefit. There are some cases where it's probable, and that's why, again, we capitalize, let's say, part of the development side of it. But anyway, I thought that is a little bit interesting. In terms of disclosure, I'm completely there. I mean, we have a lot of papers in accounting showing that we know how to capitalize the R&D expenses. If you believe these are assets and you want to do that, then nothing is stopping you from doing that. The question is whether or not, point this is an asset, and I'm still not sure that the people that says accounting is not going with a isn't fit the new world. I'm not sure that's true. I think the new world thinks too highly of its own R&D.
Well, Gil, you perfectly summarized, I think, why I think the position is that we're not going to capitalize it in the US because of this, at least that it's so hard to figure out when you switch from, exploratory to an economic like a present right to an economic benefit like that. That is, and so maybe I didn't mean to overstate. I think most people feel like there is an asset in here somewhere. It's not all an asset, right? So yeah, so let me clarify that. I think The issue is like there is an asset in here somewhere, probably. It's probably not all of it. And then the question is, how can you represent it? And I think in the end, to your point, like the discussion tended to center on like it's going to be so difficult to do that. Let investors decide. Give them as more information that you can, and let them decide, rather than have managers come up with this valuation that may or may not be accurate. Yeah. So
I had
was
a,
there another? Yeah.
yeah, when you, hi, John, I think this is really interesting. You said before, though, your exact words were there wasn't at this conference, there wasn't much of an appetite for capitalization. Was that amongst academics, amongst regulators, amongst practitioners, or across the whole thing?
Again, I don't want to speak for people, but you're right. I did say that. I mostly turned to some people that hear from all constituents. So it's not like, in other words, like I asked people that would know what, investors think, auditors think, academics think, whatever. And I think the general sense was that, like what we just said, that there, so I think it was fairly universal, I guess. That like even, I mean, there were a few that are like full fair value. Let's fair value everything. But I think measurement issues were the big trip up for most people as to why like this would be a difficult thing to portray. I think the issue is like the measurement would be so bad, we're better off not capitalizing anything and expensing it than trying to put something up there.
Because I could imagine a situation where, for example, from the auditor's point of view, they would be reluctant to capitalize. It is difficult to know where that line that Gil was talking about is, okay? So the path of least resistance, the easiest thing for them to do is to say, well, just let not capitalize. Even if they're in their hearts, they believe there is a line somewhere, and above that line it should be capitalized. And then firms themselves, if it gets capitalized and then goes south, they have to write off, and they don't want to.
You're right.
There's a lot of incentive, even for those who truly believe in their heart, that in theory, there should be an asset on the books, but it's just easier not to do it. There's less risk of looking bad, etc. So that could drive them also.
Yeah, again, nail on the head. I think it's, and as a manager, like we were talking about this, you would want to show that you're invested in projects, some of which fail, because then you're not taking enough risk, right? But then you also don't want to show that all the ones you do fail, because then you're not good at it. And so it's like it's very hard to understand like what the equilibrium would sort out to be. But I guess like the purpose of our paper, we can't really get into all of that. What I was able to say in that conference, I guess, was that I had some preliminary data on, it was this paper. It was like, hey, under IFRS, like, you can capitalize some, and but firms aren't going crazy and like capitalizing a ton. And that's, I think, what we see in our paper is that, so the first question we're trying to address is when you can do it, how prevalent is it? And then sort of, how useful is it? And I think in terms of predicting outcomes. So the purpose of the paper really is to say, in this setting, how many firms actually end up, when they're allowed to, capitalize, and if so, how much do they capitalize, and then sort of say, of the stuff that's capitalized, does it end up resulting in real things like future patents granted or patent applications? Does it end up investors valuing it positively? And then because of this setting, there's also, as an additional analysis, some disclosure going on, and we're going to see what the real effects of that disclosure mandate were. But I guess these are all great points, and I didn't mean to get us started sort of too far away from the paper, but in my head, this was sort of why I thought this was a really neat setting to look at, because I know that I feel like there is at least an appetite for disclosure improvements around R&D, and I think we can speak to that with this paper. So I don't know if I could, maybe if I could get a little bit into what we do, and then we can take more questions. So basically what we show is that, so we have a setting where we have every firm in the economy has to report this information. So we can see if they don't do any R&D at all. And then we can see the firms that do at least some amount of R&D. And within that, how much of that is capitalized, how much of that is not, how much of that is expensed. So the key findings, I think, in our data are that, less than a third of the firm years in our sample calculate or capitalize any R&D. So like 71, I think, percent of the firms that have R&D activities capitalize 0% of them. Okay. So, and then among the firms that do capitalize at least something, the average capitalization is about 20%, okay, of what they spend. Okay. So it's not like you see, 50% or more of these expenses going on a balance sheet as assets. Now that's just descriptively, but then one of the benefits of our setting is that so we're looking in China, is that China requires firms to disclose the total R&D spend, how much of that they capitalize, the total number of employees in R&D, and then they have to break out R&D expense on the income statement, and then they have to tell you within R&D expense the type of expense that it relates to. So is it labor cost? Is it materials? Is it overhead? Is it whatever? And what we're able to get from that is an estimate of how much they're paying their R&D workers. Okay, so what we can say is, of the expenditures, how much of it's labor related. We also know the number of employees they have. So what we can get is the average salary they pay to an R&D employee. And our assumption is that, that would give you some level of how committed they are to their R&D program. And so what we then do with that is first say, okay, is that representative of R&D quality? If I pay my R&D staff more, does that mean my R&D is of higher quality? And so we run some tests and show that if I have a higher salary towards R&D labor, I'm less likely to make R&D cuts around, earnings management for earnings management reasons. So I'm less myopic with my R&D investment, and I'm less likely to have employee turnover. So I retain my R&D people more, and I'm more likely to have current year patent applications, and I'm more likely to get those patents granted in future years. So the implication is that this disclosure that's being required in China of labor costs can be informative to the quality of the R&D that's happening, both in terms of like their myopic behavior towards it, as well as sort of the real effects, the outcomes associated with it. So then the next thing we look at is, okay, if R&D labor is a proxy for R&D quality, when we see firms that capitalize R&D, does that happen more for firms that have higher quality R&D as measured by higher R&D labor costs? And that is indeed what we find. It's the three biggest determinants. It's actually the biggest economically determinant of capitalization. The other two being size, just size generally, and R&D intensity, which is R&D divided by assets. And we actually, in that test, try to look for instances where, capitalization could be a short-term myopic earnings management type story. And we have several proxies for financial reporting quality, both from the prior literature and some new ones that we came up with. And we find very little evidence to none that the capitalization that firms are doing relates to sort of myopic behavior. That it's really more about the quality. And then we look for investor pricing of it. And when we look at it, we basically do a value relevance test. And we show that, as you might expect, the R&D that ends up being capitalized is positively associated with returns. So it is reflective of things that investors care about. But that when we do a cross section for that test, we only look at the firms above the median in labor costs. presumably they have the highest quality. That's where the result holds. But when we're below the median with lower R&D labor costs, the investors do not price it incrementally. So in some ways, it's implying that, you know, investors, I'm not saying they're using this disclosure per se, but we are saying that, you know, whatever they are doing to consider the quality of the R&D, it's correlated with the disclosure that we're seeing. And then lastly, and then I'll open it back up to questions. I just want to get our results out. Lastly, because we're looking at this new
John.
disclosure that shows all the expenses broken out, you know, a natural question is, if, especially for regulators, if we mandated firms to disclose R&D labor costs, how would that change their behavior? And so in additional analysis, what we look at is, you know, sure, if you mandate this, there's going to be more R&D related words in the filings. That's mechanical, I mean, you would think. But we actually show that after the mandate, R&D investment levels as a whole seem to increase. So you're not going to choke off. It doesn't, at least from our data, suggest that mandating this disclosure would reduce innovation. And then R&D quality, which again would be the labor, basically labor costs. Does that go up or down after you mandate the disclosure? And it goes up. And in fact, so it doesn't suggest that, like, you know, we're actually doing more and maybe more high quality R&D. And then when we do a cross section of this, what we find is these both things happen, like an increase in investment level and an increase in what you pay R&D employees. But the increase is greater for the firms that were below median, so that we're not really paying as much. So in some ways, maybe this disclosure encouraged them to, hey, everybody sees you're not investing as much as you should, and then they do. So, okay, with that said, I'll hand it back to the moderator, who's going to have a good time figuring out who to go to next.
Yeah, so yeah, it's nice time to answer questions because we got so many people who want to ask your questions. So I think the first person would be Bharat.
Yes, thank you, Mami. I had a couple of questions for you, John. Hi, how are you? First,
Good to see you.
Yeah. So, what percentage of firms in China actually report a separate line item for R&D? In the US, it used to be about a third. I don't know what the proportion is now. That was the first thing. And the second thing is, I mean, it goes back to the question of the life cycle of the firm. Startups tend to pay in sweat equity, right? I mean, they don't really pay cash wages. So how do you control for that?
That's a great point. So we have, it says compensation and benefits, is what it says. So presumably it would pick up this, but I think you're raising a good question. Like what's, you know, presumably their incentive compensation would be based on doing a good job. And maybe what we're picking up is that they're getting bonuses because they're doing a good job. I don't know. But these are things we could maybe dig into. Like I think, as I said, this was the first draft of the paper. I think we don't even have an example of the disclosure in the paper. I've got one in my slides I can get to, but obviously we need to add that. And then I think a lot more descriptive, which is sort of the crux of your comment, a lot more descriptive information about what's there, because I think that's like, we've just done a first step, right? But making this data available to other people, you might be able to, you know, there should be a lot of research that could be done with it perhaps.
Thank you.
But to answer your first, so I don't know. I'd have to look it up in terms of what percentage have a separate line item as the overall economy. But we can do that and compare it to the US. And then I think we want to dig in and understand how is our data capturing incentive compensation or stock option compensation.
Thank you.
So the next person will be Brett.
Hi, John. I wanted
Brett,
to
how
ask you a
are you?
little. Good to see you today. Hey, I wanted to ask you about how you're characterizing this 1/5 so out of all the Chinese companies that capitalize anything, only 1/5, they only capitalize 1/5 of the proportion of total R&D expenditures. You're saying that's very low, right? So I wanted to get your thoughts on how informative is that? Like if you told me I could have a 20% success rate on my R&D investment, I would take that in a heartbeat, right? If a lot of this is maybe exploratory, So could it be characterized as being really high too, right? That's showing the proportion that I'm believing is going to have an economic benefit. Could that be looked at as a really high success rate on the flip side?
Yeah, that's a fair point, and I shouldn't have. I guess I need to be more agnostic and just report what it is rather than.
Well, it's interesting.
But
Yeah.
no, I take your point. It could be viewed as. I mean, I was viewing it as it's not 100%, but of course it wouldn't be 100%, and so I think you're right that we need to be a bit more measured in how we describe that, and maybe point that out that 20% could indeed be fairly high. But your comment made me think. Oh, so one of the things that I've thought about to your point about like if we thought there was too much, if it was too high, I think what we could look for is subsequent impairments. And so
Right.
What I've tried to see if we can do, add the test, is to say like of the ones that are capitalizing, what's the likelihood of a future impairment of that amount? And that's a test I think, I don't know if we can get the data, but that's one I'd like to do because I think that would be an indicator that maybe it's too much.
Well, I think it's interesting to tie it back to your earlier discussion about what constitutes a definition of an asset, and Gail brought up that point too. And so if they're just capitalizing, these exploratory things with holes, the holes in the ground was the analogy I like the best, right? Oil exploration. Is that adding value, or is there economic benefit, or is it just when it meets those milestones or feasibility or things like that? So that's interesting to tie that back.
Yeah, that's helpful. Thank you.
The next person would be Sok.
I think you might be muted.
Well, thank you so much for the nice paper. My question relates to the accounting issue, and under the IFRS, you cannot capitalize all of the R&D.
That's right.
You can capitalize only the development part,
Right.
and the research part has to be expensed. So when you start an R&D, initially it's going to be all research, and when you execute the R&D, initially it's going to be all research. And that part has to be expensed by IFRS. So later on, when you have some success, then you can capitalize the development part. And if the R&D is not going to be successful 100%, company won't be able to capitalize all of them. And as a result, the development part essentially reflects the portion that R&D was successful. And so I'm a little bit confused about whether your paper is about accounting or whether it's about the success of the R&D, because in my mind, if the companies are sticking to the IFRS accounting rules literally, the 30% of the R&D capitalized represents successful R&D. So I'm not sure whether you are predicting the success of the R&D in your paper, or you are looking at the accounting issues, whether they are capitalizing the right way. Okay, so
Yeah,
essentially,
I think it's a
little bit, yes. Yeah,
it's
sure,
a good question. Good point. So we try to be very careful on the paper and point out, yes, I mean, you're absolutely right. Like you can't just capitalize. There's actually a pretty stringent test, right? To where you go from research to development, and then you can capitalize. And so there are I think there's a footnote where and maybe in the text, I think there's 5 or 6 criteria that have to be met before you're in the capitalization, criteria. I mean, at the same time though, like if a firm wanted to be aggressive with it, I mean, they could probably argue that they meet those criteria, right? I mean, so I think, but I think what we're trying to do in the paper is take as a given whatever they've capitalized and try to explain what it is, right? Does it? So I think your question was like, are we testing the accounting or the quality? I think we're testing the quality. In fact, that's in the title of the paper. Yeah. So, the amount that is capitalized and the quality of it, that's basically what we are testing. And so I don't know if it's maybe a joint test, but in this setting, you're allowed to do this. And so all we're trying to say is whatever ends up getting done, does it seem to be of high quality? So I think that's really like where we would try to position the paper.
So the next person will be Peter.
Thanks. Hi, John. Thanks for the presentation. Just a quick point which follows on from the previous comment, actually. On several occasions, you and the previous commentator used the word can capitalize. Well, it's actually not a discretionary item. If certain recognition criteria are met, then development costs must be capitalized. And those recognition criteria, refer to, this is an IFRS, by the way, and I don't know how convergent Chinese GAAP is, but, the recognition criteria refer to the technical feasibility of completing the intangible asset and the intent of management to do so for use or for sale, and also to have the resources to do so. So, I think it's kind of a bit misleading to frame the narrative as there being an element of discretion. Of course, there may be some ambiguity in whether or not recognition criteria are met, but the standard
That's the, I
says
think, yeah,
those
that's the
costs
thing is when we read,
must be capitalized.
right. No, you're right. So, and I think we say it in the paper, and I've been loose in the presentation, but yes, if the conditions are met, you have to do it. But the conditions being met, I think, you could, it's a judgment call, right? And so, but
as the previous commentator said, then you certainly can't meet them if the R&D has not been successful.
Right.
To the point where the asset can be developed for use or sale.
I mean, I feel like that's kind of what is lost a little bit in the discussions and maybe I was just not interpreting the discussions correctly. But I felt like, it's not like it's not the Wild West in IFRS, right? It's not like you can just capitalize willy-nilly. It's pretty, and maybe that's why it's not surprising that what we're showing is that it's not managerial discretion that much. It's really economic substance, and the stuff that is of higher economic substance is when firms appear to pay their employees better. Maybe they're just more committed to an R&D program. But I feel like that did seem to be lost in the U.S. discussion, is that like I think the view of the U.S. is that again, I don't want to put words in people's mouths, but was that they didn't know how to actually implement that, that switch from when it goes from exploratory to economically feasible.
Next, Gil.
Hey, so first let me thank you for, it's been a while since I've been in an accounting seminar and actually talked about accounting. So I'm like, thank you for that. I really do appreciate it. So I do actually have a counting point, which is again, twice in one seminar, which is, but so I think it's very difficult for us to actually observe the R&D spending in the way that we're thinking about it. And because again, there's a direct cost, right? I'm going to put managerial accounting here for a second. And there's essentially the allocated overhead that is allocated into the R&D costs. So when we see the R&D expenses changes, given also again that we know that there is a valuation component to it and a disclosure and incentives, it's not that easy for us to examine within all the items, essentially how much are we allocating? Let's say, okay, now more of the CEO and the, you know, the administrative cost in the payroll is kind of going to be allocated into it, versus how much really is changing in the sense that this is going to be real direct investment in the R&D. So for us as outsiders, I mean, it's much more difficult for us to really identify that. But again, it's not that that makes it less interesting. It's just another like complications in what we're trying to observe.
No, I agree. I mean, that's what I thought of. That's where I thought the disclosure that Chinese firms have to do was so interesting, because I think it, like, here's an example of a firm showing, you know, and one point someone said to me, well, is all the R&D salary? It probably is, right? Well, in this example, no, it's like less than half of it. There are other things that go into this. And again, when we combine this with the number of employees the firm has, that's how we're getting sort of the average amount of that they're paying. But you know, so maybe your point is like, if we mandated this disclosure, it would be hard for firms to do. I don't know. But what we are looking at is where, in at least in the Chinese setting, this disclosure is mandated and we're able to get some data on it. So it's at least more clarity than, and I'll say this, like, one of the things that I was thinking about with this is that I'm sure that if some disclosure, if you get too specific, firms are not going to be happy about it, right? Like, if I tell you like the specific projects I'm working on, then my proprietary costs are, you know, just gone, right? So if you're trying to mandate disclosure and you don't necessarily, you're trying to balance sort of like disclosing more without saying exactly what you're doing. You know, that's what I feel like, that's what this disclosure has done. Like, you're going to see where they're spending the money. It's not telling you like exactly what they're doing, right? And so it's sort of it feels like sort of a nice balance between sort of providing more information but not giving away the secrets. I don't know if it was a point I felt like we should have made more clearly in the paper.
Next, Agnes.
Yeah. Hi, John. How you doing?
Good. How are
Sorry,
you?
my camera doesn't work, and I have to call IT to fix it, so couldn't, share the screen. But yeah, thank you for presenting this. It's so fundamental, important question, and I think from the up to now discussion that you are really investigating a mandatory disclosure and in China, and the quality of the mandatory disclosure is pretty good. However, there could be a voluntary element in it. And so I'm actually thinking about that. Possibly can also discuss all the part of the voluntary part. And because if you capitalize an R&D, it has to be recognized as future expense. And companies that at beginning that they don't have a lot of research activity, of course, even if they have got patent, they may not have, may spend a lot of money at the beginning and too much expense. So they may want to capitalize it. But later on, when they are mature and they are going to recognize or continue to invest in R&D, and but they're also going to allocate the previous ones. I think this kind of time changes or at beginning or ending. I think someone also mentioned a life cycle, so that could affect the determinant of them capitalizing.
So that's a great point. One of the things that we talked about in the last couple of days was exactly your point. So if you capitalize stuff, then it's going to get expense, and that's also ends up being part of the expense in future periods. So and this goes back to probably the initial point from Bharat, but like, I think we want to dig in more in the paper and for ourselves, understanding sort of exactly what you said, like what exactly is in this payroll, employee benefit, whatever, but then also time series wise, like, you know, how is it changing? And then to your point, once we've understood that, do we have data that can then go into the capitalization determinants model and see if that also impacts decision making?
Thank you.
Yep.
So next, Barrett.
Hey, John. Good to see you. I enjoyed this paper and kind of like Ilse, I like ones that are directly related to accounting, which is a great thing about this seminar series. I have a few thoughts and see if I can synthesize them into a coherent question. But thinking about Sock's comment earlier, and he was asking, is this paper really about the accounting, or is it about essentially, you know, how successful are firms, you know, in turning R&D into development projects? I got the sense reading it that what you want to say is the capitalization of R&D opportunistic, or is it
That's right.
or is it opportunistic, or is it informative?
Right.
The opportunistic doesn't appear in the paper, right, as a
Right.
word. So you don't really kind of go directly at that, which I was a little bit surprised about. But I think that's what you're trying to say. And it also ties into Brett's comment, which is, hey, well, is 20%, is that too high? Or is that too low? Like, so how do you speak to that? And so then I was thinking about your value relevance test, right? Because you're trying to get at this idea: is this an asset? Is it something? Is this informative about whether it's an asset or not? And so here's the real tricky part. When it comes to your value relevance, you're saying, oh, this is only value relevant for firms that have high quality R&D as proxied by the you know, the amount of labor costs. What's your market efficiency assumption there, and how would the market, if you see a capitalized R&D number, distinguish whether that is a high quality R&D or not? You find that the market values it more when you say it's high quality, but how would the market distinguish that just based on the disclosure?
Yeah, I don't. I think one of the things that we did put in the paper very clearly is like these two sentences. I went back and looked at them. I'd be like, we cannot say that the disclosure is helping investors price this. Like, I don't think that's anything we could say, because we're, like you said, these are long window association tests. They're not short window tests around the disclosure. But I think, to your point, probably is that, like, what we can say is that however the market tries to assess the value of a firm's R&D program, it is correlated with the portion of this disclosure related to salary of R&D employees, or sorry, pay to R&D employees. And so at least maybe the disclosure reflects what investors care about. We can't say that they care about the disclosure directly. Does that answer?
Yeah, I mean, I totally agree with that. And I guess they're really two different things. So are managers opportunistic about it versus is it informative? Because then the question is, well, it could be informative, but it could be informative noise, right?
Yeah.
Like
Yeah.
some amount of it is informative, even if it's not exactly the right number. Anyway, yeah, I don't have.
I think you framed
that,
the first part really helpful. It helped me think more about the question. I mean, I think you're right. Like, it's sort of a joint test of and it's sort of what I was trying to say is, like, let's see what firms do, and then let's see, does it seem to more reflect information that's informative, or does it appear not to be informative? And
right.
that's,
And you said
I don't know if I go as far as opportunistic, because maybe that word's not in there, because that's harder to assess from an archival standpoint. But
yeah, if you could do the thing on impairments, which you said you'd like to do, but you don't know if you get
Yep.
the data, that
Yep.
obviously would help to that end. So anyway,
exactly.
I think it's
And
really
then, but we
interesting.
do, and we do have the earnings management test, and we don't see much there either. But But I think you're right. Like we need to maybe think more carefully about like it's the joint test that we're trying to what we done. So thanks.
Next, Ayang.
Hello, John. I have 3 questions. I will be as precise as possible given the time we have. The first one is, I think earlier you talked about your paper actually doesn't really inform us of whether disclosure would be the ideal solution to this issue, right? Because you are in the regime where all the firms actually have to disclose. And when I look at the example you put on the slide now, I kind of think about it doesn't matter whether that amount is actually disclosing the income statement or balance sheet. On top of that, you can require firms to provide such detailed disclosure in the footnote. It can be a footnote attached to a recognized amount or not, right? So I just want to clarify that the empirical exercise you have here is interesting on the heterogeneity among R&D projects, but like does not necessarily inform that whether we should expense capitalizing or expensing with disclosure. It's not a study to actually really test all those different regimes.
No.
Is that, yeah.
Are you saying like, say you don't capitalize it, but instead you say if I capitalize, here's what
Because
it
you
would
were
be.
talking about the US, like the earlier discussion
Yeah,
that
yeah.
investors constituent, they kind of like do not want to capitalize, but they want expensing the income statement complemented
I
with
see. Yeah.
disclosure. But when I look at this, well, think about like revenue recognition. You also have very detailed footnote disclosure attached to recognized number. So I kind of feel like the discussion even earlier is about recognition versus expensing. Recognition in the balance sheet versus expensing, but with or without disclosure, I think that is a separate issue. It's not that they are mutually exclusive. You can only pick
I
one.
agree. In fact, I'm guessing you mentioned the paper in the Korean setting that was presented in this series last semester. So they wouldn't have the disclosure that we have, but they have the other stuff,
Yeah.
right? So
Yes.
So so I think your point is that they're different, and I think we need to incorporate that paper and maybe point that out. Yeah.
I think.
I guess the thing that I thought was most exciting was that at least a component of this additional information seems to correlate with R&D quality. And if you were looking for something to disclose more about your R&D program, which I think they are, I think the regulators in the US are, that at least we've got some basis for this being one of the components they consider that firms disclose.
Yeah, I think I agree with you. I think more disclosure about heterogeneous nature of R&D projects within the firm that is not observable by outsider is always helpful, regardless where do you recognize that amount, which statement do you recognize. The second question is clarifying question. The example here is only the R&D expense in the income statement, or is the total dollar amount or spending?
It's only it's only the expense. In fact, there's two primary places the expense shows up. One as part of gross profit in firms that have a gross profit. So some would go into and then some are like down below. And then but then you're right. So what we had to do in the paper to try to estimate, we're only picking up sort of the amount they spent, that was expensed and not capitalized, is we make an assumption that the same ratio of this is what would be in the capitalized amount as well. And again, we're pretty clear about that. And then we look and we validate it with the tests that kind of say it, but we don't have, even these disclosures are not, perfect. They don't tell you all of this. Yeah.
So my last question is that whatever being capitalized today is more mature projects. So have you thought about whatever capitalized today should relate to the labor expense or whatever expense from the previous period?
Okay.
Apply
So, yeah, that's a fair.
R
Yeah.
for multiple years before they reach the D development stage. So
Right.
your dependent variable is the amount of the D relative to total, but your right-hand side variable actually is the R from today rather than the R from the past. I think that there's a kind of like disconnection in terms of timing. Yeah.
I
And
agree. That's a good thing to consider. It kind of gets at Agnes's point as well. Like, there's probably some time series variation here we could learn from, as to how all this stuff flows through. And I think we should do our best to get a handle on that. Yes. All right. I see one hand up, but if not, I can kind of walk through some more of the data. So, I think we've talked about some of this already. But what I think makes maybe the Chinese setting, this is sort of a timeline here, is that in 2007 is when they largely converged with IFRS. In 2015, so there's actually two different disclosure mandates. I think it's useful for people to understand. So in 2015 is like their version of the SEC, and they mandated that public firms disclose the R&D details in terms of what's capitalized versus expensed, and the number of employees working in it, and that stuff in the MD&A section. Okay, which is the part that the SEC regulators would have some sort of oversight over, but they didn't. But then, like sort of in 2018, that's when sort of the regulatory body most analogous to the FASB, the Ministry of Finance, did the footnote disclosure and the separate call out on the income statement. So there's actually sort of two bodies working on this improving this disclosure. And I guess that, in a sense, would tell you like, hey, it's not just the FASB that has the authority to do something here. And then that's where, this is the part that's in MD&A. And this was the stuff that was put in place in 2015. So hopefully you can see here. Let's see here. This is what we're seeing in terms of how much of this, in this case 34% was capitalized. Okay, so this is one of the higher numbers, and they had 761 employees in the firm, and that's the stuff that their version of the SEC put in the MD&A. Okay, then when we move forward to the footnotes, and again, it's a little bit messy because part of the R&D expense is in sort of gross profit, and then part of it is below. But then there's got to be a footnote disclosure breaking it out by these components. And I think I see Paul's hand back up.
So John, we got a question from Paul.
I just want to understand this. Could you go back that one slide back? Yeah. So, okay. So the total credit in the entry is 368 plus 190. And on the debit side, so the debit side is debit to expense 368, a debit to asset 190. That's what this is telling me, right?
And credit cash or something. Yeah.
Right, credit cash, right. So the 3409 is 190 divided by 368 plus 190, right?
Yes.
Okay, all right.
So the third line there is the sum of the two. So
I didn't see that. Yes. Yeah. Okay, I just want to make sure I understood. Okay.
Sure. And then you can see anyway. So so I mean, I think this data is there, and that's what I'm saying is we probably need to do a better job in the paper of we don't have any examples, so obviously we need to add those. Like I said, we just finished the paper in November, and then I think probably do a little bit more analysis on the data that we have. But so speaking of the sample period that we have is 2017 to 2021, because this expense disclosure that had the breakdown of labor costs didn't happen until 18. And then, of course, when I present 18, I have to also give you 17. So we're able to go to 17 for the sample. And we use sort of the Chinese version of CRISP and CompuStat to get the R&D information, and the stock price information. And then we use to get patent information and textual analysis. We use I think their version of Edgar. And
John,
so, yes.
I just want to tell you, you have only 5 minutes left.
Okay. So, you know, I guess I could, you know, show you some of the tests, but again, like, so we have this indicator for did you capitalize anything, and then we have a more continuous measure for how much did you capitalize, and here are the descriptive statistics that I pointed out earlier, that for the 11,692 firm years in our sample, like, you know, only 29% of those firm years had any amount capitalized. Across the whole sample, you know, it's not much. It's only 6.5% of the total R&D spend across the whole sample ended up being capitalized. And you know, then we talked about, you know, so that's really more just descriptively what's happening. And as was pointed out earlier, I can't really say a lot as an empiricist, you know, other than this is what we observed. And then the question is, like, you know, with the R&D labor costs, we thought, you know, could that tell us something about the quality? And so here you see the variables of interest in the regression, but this is the R&D labor per employee that we were looking at. And so you see that they're less likely to cut R&D as a percentage of sales, or R&D as a percentage of expense, when they pay their employees more, because they're more committed to the program. And then here's the regression where we show that when you have higher labor costs, you actually have a higher occurrence of patent applications and a higher occurrence of future patent grants. And then also in here is R&D retention, where we just look at what's the volatility of the R&D labor pool, because we have the number of employees, right, that's doing R&D in that period. So we kind of look at, you know, how stable is it, okay? And we see that if you pay R&D people more, that is a more stable number of employees. You don't see wild swings in it where we add people in some periods and subtract in others. And then here's the main sort of regression where we put the capitalization percentage is the dependent variable here. And then we're trying to explain, you know, what is associated with what gets capitalized. And of course, we got our variable of R&D labor, but we've also got variables that the prior literature's looked at, like earnings volatility, the size of the firm, the growth option, you know, mark to book, R&D intensity level, whatever. And the key finding, I think, is really, I mean, it was R&D labor did end up being sort of the largest statistically, economically meaningful determinant. Size was almost the same, and R&D intensity, meaning R&D expenditure divided by total assets. So, you know, if you're bigger, if you tend to be more of an R&D type institution, and if you spend more, those are the things that led to more capitalization. So it's not like the firms that are able to meet this criteria under IFRS and capitalizing appear to be firms that wouldn't be good at creating R&D, right? These are firms that you think of sufficient size, sufficient investment, both in terms of the overall spend and the amount they're spending on their people. So I think this is, again, maybe to Barrett's point, is like it's consistent with what's getting capitalized being informative, and is inconsistent with what's being capitalized being not informative. Okay, and then we also kind of look at we put some more variables in this regression to try to see if there's any evidence that, you know, if a firm restates a lot or has poor reporting quality or wants to meet or beat its earnings expectation or any of those things, like, is that related to capitalization? And we find no evidence of that. So again, for Barrett's point, like, we're not seeing that capitalization appears to be opportunistic. What we are seeing is that it appears to be reflective of maybe higher quality programs. And then let's see. So this is just the standardization where you can see that the economic significance of these three were roughly the same. Okay. And then this is the value relevance regression, which is, you know, we find the beta 2, and this is where we partition high R&D labor versus low R&D labor, and we find that, you know, it's only holding in the high R&D labor. And I know I'm out of time, So I'll just conclude by saying thank you all for your comments. Like, this is very helpful. Again, this is the first time presenting, and that's always like when you teach a class for the first time, like, you know how you know it, but you don't know how other people are going to receive it. And we've gotten a lot of good information to sort of think more about how we can better articulate what we can and cannot say. But in general, what I think we can say is that we do provide some evidence that in a setting where all firms are at least required to do this MD&A disclosure and this footnote disclosure around R&D. And so we have a really broad sample of firms, and we're going outside the US where the accounting standards are a little bit different. We're finding evidence that what ends up getting capitalized is of higher, is informative. It's not of low quality. It doesn't seem. That one of the key variables we've been able to identify is that how much you spend on your R&D employees might give you some evidence of the quality of the R&D program. And if capitalization was off the table because you just felt like it wasn't going to be something people would get behind, and disclosure is what you want to add, and then you're faced with constituents that don't want to disclose very proprietary information about exact projects they're working on, maybe one thing you could do is give more idea of how much you're paying your R&D employees, how many of them there are, and so on. And that might be able to help you with improving sort of transparency around R&D. And lastly, I just need to put this up on the screen. The next event is on February 7th, and please register. It'll be about leases. So another accounting topic that'll be great. So
very interesting paper, John. Thank you.
Thank you, guys. Thank you, everyone.
Thank you, John.